Welcome back, everyone. Whether you're a chartered accountant, a CA student, or a tax professional gearing up for the upcoming changes, this explainer is absolutely for you. Today, we're zooming in on a very specific, highly practical area of the new Income Tax Act 2025. We're going to break down Section 127, which deals with deductions for the maintenance and medical treatment of a dependent with a disability.
Picture this. It's tax season. A client walks into your office wanting to make sure they are properly providing for a dependent family member with a disability, but they also want to stay fully compliant and, maximize their tax benefits under the new 2025 tax regime. So how exactly do you navigate these new waters? Well, let's dive right in and make it crystal clear.
All right, here is our roadmap for this explainer. We've got 1. Introduction and transition, 2. Key legal provisions, 3. A practical case study, 4. Compliance in Form 30, and 5. Practical issues and summary.
Let's kick things off with Section 1, Introduction and Transition.
Now, if you've been practicing under the old Income Tax Act of 1961, I'm sure you are intimately familiar with Section 80DD. Notice how directly the new law maps to the old one here. Under the new Income Tax Act 2025, Section 80DD is completely replaced by Section 127. So the core spirit of providing tax relief for the care of a disabled dependent, that remains totally intact. But the section numbers, the reference rules, and the compliance forms have all been updated.
Moving right along to Section 2, Key Legal Provisions.
Before we even think about claiming a deduction, we have to legally establish who actually qualifies, right? As per Section 127, subsection 9, Clause B, a dependent for an individual taxpayer includes their spouse, children, parents, brothers, and sisters. If we're talking about a Hindu undivided family, it means any member of the HUF. But here is the absolutely crucial condition. They must be wholly or mainly dependent on the assessee for support and maintenance. Also, the dependent cannot claim a deduction for themselves under Section 154 of the new Act in the same tax year. It's strictly an either-or situation.
So, how do we actually claim this? Well, the law provides two distinct avenues. Avenue 1, you can claim a deduction for actual expenditure incurred for the medical treatment, nursing, training, and rehabilitation of the dependent. Pretty straightforward. Avenue 2, you can claim the amount paid or deposited into an approved scheme framed by the Life Insurance Corporation, the administrator of UTI, or another specified company. You don't need to do both, by the way. Either avenue unlocks the deduction for your client.
And what's the actual benefit here? For a dependent with a general disability, the maximum deduction that can be availed is 75,000 rupees. This acts as a flat deduction threshold, which is honestly a significant relief for families bearing these kinds of costs.
However, if the dependent suffers from what's classified as a severe disability, which legally means 80% or more of one or more disabilities or specific severe conditions, that limit jumps all the way up to 125,000 rupees.
Let's see how this works in the real world with Section 3, a practical case study. Let's track the life cycle of an approved scheme deposit under Section 127, subsection 2. Imagine a taxpayer sets up an LIC scheme for their disabled sibling. They deposit money annually and claim the deduction. Now, the statutory conditions dictate that this scheme must eventually pay out an annuity or a lump sum for the benefit of the dependent. So when does this payout actually trigger? Well, it happens either upon the death of the subscribing taxpayer or, and this is a really important addition, when the taxpayer hits 60 years of age and stops making further deposits. At that point, the dependent starts receiving the financial benefits. But what happens if the unthinkable occurs and the dependent passes away before the taxpayer dies or turns 60? This is where Section 127, subsection 4 kicks in with the deemed income rule. In this specific edge case, the amount that was deposited into the scheme reverses. When that money is paid back to the assessee, it is legally deemed to be their income in the tax year it's received, meaning it becomes chargeable to tax. This is a vital practical consequence that you definitely need to warn your clients about. All right, on to Section 4, Compliance in Form 30. Because, as we all know, knowing the law is only half the battle. Proper filing is where tax professionals really earn their keep. The income tax rules of 2026 have completely overhauled our forms. We are officially saying goodbye to Form 10 IA. As per Rule 61 of the new 2026 rules, to claim a deduction under Section 127, you must now file Form 30. And remember, this form has to be filed along with the return of income.
Now, you can't just get a certificate from any local clinic down the street. Rule 61 strictly maps out the prescribed medical authorities.
For conditions like autism, cerebral palsy, or multiple disabilities, the certificate has to come from a neurologist with an MD in neurology or a pediatric neurologist if it's for a child. Alternatively, a civil surgeon or a chief medical officer in a government hospital is legally authorized to certify the disability.
Let's walk through the exact step-by-step electronic filing process for Form 30 right out of the official guidance note. First, you enter the basic assessee and patient details. Second, you input the specific certificate and disability details, and this includes noting whether the condition is progressive and requires future reassessment. Third, and please don't miss this step, you absolutely must upload a PDF copy of Part B of the form, physically signed by the medical authority. And finally, you e-verify the whole thing using a digital signature certificate or other.
Let's wrap things up with Section 5, Practical Issues and Summary.
Listen up, because here is a massive compliance pitfall. A question we hear all the time is, hey, can we just submit the same medical certificate every single year? Well, according to the official Form 30 FAQs, if the disability is temporary and the medical authority recommends reassessment after a certain period, that certificate effectively has an expiration date. To quote the FAQ directly, no deduction shall be allowed if the certificate issued by the medical authority certifying disability has expired. As tax professionals, it's absolutely critical that you track these expiration dates meticulously for your clients.
All right, let's bring it all together with our key takeaways for today's explainer. Number 1. Section 127 of the Income Tax Act 2025 is the new home for disability-dependent deductions, taking the place of ADD. Number 2. The deduction limits are 75,000 rupees generally, or 1.25 lakhs for a severe disability. Number 3. Always remember the deemed income rule if a dependent passes away prematurely and scheme funds are returned. Number 4. Form 30 under Rule 61 replaces the old Form 10IA. And finally, number 5. Electronically filing Form 30 is completely invalid without mandatorily uploading the signed Part B from an authorized medical professional.
Understanding these provisions ensures that vulnerable dependents are provided for and that taxpayers remain perfectly compliant. But as we transition into this whole new regime, it leaves us with one big question. Are your firm's internal checklists updated to track these new Form 30 expiration dates? Think about it. Thank you for watching. Please like, subscribe, and share.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.